Good morning, everyone. Kathryn Petralia, our guest this morning, founded Kabbage with Rob Frowine in 2008 to solve a glaring problem in the small business market, which is access to loans, particularly loans below $250,000, which account for about 75% of all loans to small businesses. Now, since that time, Kabbage has grown like a particularly robust leafy vegetable, and as of the last update of your bio, Kathryn, Kabbage had lent billions to over 130,000 small businesses. That's still the operative number?
Still billions, almost 5.
Yeah, okay, still billions. Kabbage has helped define one of FinTech's most dynamic categories, which, as of last measure, accounts for 21% of all small business loans. Congratulations on that. By the way, Kabbage is a multiple Inc. 5000 honoree, which is quite an accomplishment. It's hard enough to make the list of America's fastest growing companies once, let alone many times. So congratulations on that. Always glad to see another English major succeed.
Thank you.
Now, going back to the founding story back in 2008, it's obvious that there was a gaping white space for you to fill, but the reason it was there is that it's so hard to make money lending to small businesses. What insight did you have that made you feel like, hey, we can make a go of this?
Well, it's interesting. Our story isn't that we had small businesses and so we had a hard time getting capital. It was really inspired by an API. eBay had launched an API that allowed third parties to get access to seller and transaction level data, and it inspired my co-founder, Rob, to say, wow, I wonder if you could use that information to make a real-time loan to an eBay business. Certainly an underserved market of an already underserved market. And so that's how we got started making loans to eBay businesses. And so we've grown a lot since then. Today that e-commerce probably represents only 10% of our customer population. But the idea was real-time access to third-party data we can use to give people access to capital instantly. So even today, on average, our customers are spending 7 or 8 minutes through the entire application process to get access to capital.
Wow, that's great. So who is a typical customer?
Well, a long time ago it was e-commerce businesses, but today it's really everybody. So I would say what categorizes all of them is they're looking for less than $250,000, for one thing. On average, they're generating a few $100,000 a year in revenue, approaching 5 now because it's growing. It's everything from, doctors' offices and construction companies and spas and salons and restaurants and retail, and I mean, you name the kinds of companies, and they're in our pool.
And are they coming to you because they've been turned down elsewhere, or are they attracted by the speed of the access to capital?
A lot of it is about speed. Karen Mills at Harvard published a couple years ago a study about access to capital, and half of businesses who are seeking capital don't get it. So a lot of our customers have gone down that path, but the other half who aren't seeking capital, a lot of them aren't seeking it because they don't think they can get it, or because they think it's going to be hard, or they're anxious about all the documentation they have to provide, and they don't understand necessarily what that entails. So from our perspective, a lot of our customers could get access to a loan from a bank, but they don't want to deal with potentially a personal guarantee, or they don't want to deal with having to keep funds at the bank, or whatever all of the requirements are. It depends on the bank. They make it hard for them.
7 to 8 minutes, typical application?
It is.
What kind of information do you ask for?
For the most part, we're looking at information that they use to run their business. So everyone gives us access to their business checking account. And they also are giving us access potentially to accounting data, depending on what accounting platform they use, payment processing information, shipping data, social data. It runs that gamut. There are about 22 options they have. They select what they're going to tell us.
Okay. And what percentage are improved?
If a business is generating at least $5,000 a month in revenue, then we'll approve somewhere between 70 and 80% of them.
Good. That compares with well below half for banks.
For sure.
So the data that gives you the insight that allows you to make a fast turnaround on loan approvals, kind of what is it and how does it work, and is it affected at all by AI?
Well, so I love AI makes me giggle a little bit, just because it's really, there's machine learning, AI, all of these things are really just about using data in a new way to make decisions in an automated fashion. And so from our perspective, we do use those tools. And it's important to use the tools because they can comb through lots, massive quantities of data in a very short period of time and come up with some unique insights. So a couple of examples, we actually built a model using social data that was more predictive than credit bureau data. And we did the same thing with shipping data. We actually have a standalone model using only shipping data that we found was more predictive than bureau data. So, and there's, obviously there's a lot of things that go into that, and there's a lot of controls in place for that. But it's really interesting mining that data, the unique insights that you find, especially by industry.
Interesting. Okay. Well, so underwriting is one part of the equation. The other part is pricing. Obviously, these are high-risk loans for these borrowers. How do you set the pricing so that you guarantee a profit for yourself?
Well, it's risk-based pricing, so every customer is different. There are multiple tiers within our portfolio, so the rates vary. Our average effective rate is in the mid-30s, so which sounds high for consumer lending. It's not for small business borrowing. And from our perspective, we're trying to give them the lowest possible rate, but as you know, it's risky to lend to small businesses. Over time, though, we've been able to lower our rates because we've been able to see better performance in certain segments. And so we're really excited about continuing to do that, especially as we get access to lower cost of capital. Obviously, we don't have bank capital, which I think they're getting paid for that money right now. So.
Yes. Well, let's talk about raising capital. Who are your sources of capital?
So we have multiple facilities that we use to fund the loans. We securitize the receivables. And so, all the investors you might imagine, traditional institutions, insurance companies, pension funds, all the usual suspects.
Okay. Do you have any loans on your own balance sheet?
We do. We take balance sheet risk as well, but mainly we bear the risk of loss. So there's a percentage of the loans that we fund of every loan.
Now, the payments that small businesses make to Kabbage are not expressed using a conventional tool like APR. It's a fee. Could you explain that?
Well, we do actually express APR when customers borrow. We founded an organization along with a couple of other lenders called the ILPA, the Innovative Lending Platform Association. The purpose was to actually make it easy to compare rates across multiple products. So the terms are expressed in total cost of borrowing, which is what our customers care about the most, and APR and the fee percentage. So there's all kinds of ways to do it, and the challenge was there's so many different types of products that are available. There's factoring and merchant cash advance and credit cards and equipment finance. I mean, you name the type of product, and if you're shopping, if you're a small business owner, it's very hard to understand how much you're actually paying for those products.
Mm-hmm. What are the loans for the most part? Are they for operating expenses, expansion, cash flow management?
It's generally working capital. Most of our customers are using the funds to grow their business. In fact, we can see in the data our customers are growing revenue by 75 to 78-ish% if you look at revenue before they borrow and after they borrow. So that's really exciting for us because you want to actually be able to see the behavior that you're trying to encourage.
You've got to make sure those fast-growing companies get recommended to the editors of Inc. The space that you entered was white space back in 2008 when you started it. It is that no longer. There are a ton of competitors there. What differentiates you from, On Deck, Funding Circle, Can Capital, Biz2 Credit? I could just go through the list, and many of whom have spoken on this stage. But what makes you special?
Well, one of the things that's different is we have a relationship with our customers. So it's very, and the reason is because we have access to data in real time and on an ongoing basis. We're able to provide a unique product. It's a line of credit, so our customers can borrow as much as they want to up to their line amount. On average, they're borrowing 22 times over a 4-year period. So that's one thing that makes it different, but it also gives us permission to offer them other products, and it gives us the ability to find the right products for those customers. So we're building a payment processing business today, and we're thinking about other products that help our customers manage cash flow. So from that perspective, I would say we're very different in that we are a technology company, and we are approaching this from a relationship perspective, and we're building new products to serve this customer. We probably look a lot more like Square or PayPal in a year than we look like any of the monoline lenders that you mentioned.
Oh, that's interesting. So that is an expansion of your business in a brand new direction, and all you needed was 2 more competitors like PayPal and Square.
Well, they're tiny little companies.
Yes,
I don't know.
right.
I don't
That's
think
right.
It's going very well.
So tell me about that. The term that you've used is cash flow as a service. Have I got that right?
We have used that. know if I really like that particular term, but at any rate, yes, that is what we're doing. Rob and I talk all the time about cash flow as a service. We're trying to come up with, if anybody has a better name for that, just let me know later. But the idea is that our customers are really, it's all about cash flow. It's accounts payable, accounts receivable, it's treasury services. It's it's all the things that they have to think about every day that distract them from focusing on the business they really want to run. And so the goal is to help them make decisions and to sort of guide them and be a partner with them in that process as the funds flow through their business.
You mentioned that SBA study by Karen Mills, the former head of the SBA. I guess it was a Harvard study. But she describes your corner of FinTech as moving into a new phase in which the incumbents that you've spent the last decade disrupting are moving in, taking investment positions or becoming competitors themselves. Talk a little bit about that new phase. Do you see that happening in your business, and what does it mean for the future?
Well, we are seeing it now, in as much as PayPal and Square, for example, are moving into the lending business, and they're doing it aggressively. Amazon has done it, Intuit is doing it. So, and you're seeing that happen globally as well, with Alipay, as an example, getting into being in small business lending. So I think that everybody sees that that's a really big need. And companies like Square and PayPal have a big pool in which to fish, and they have a lot of data they can use to serve those customers. So getting outside of that pool is what you're seeing them both do right now with the acquisitions that they're making. In Square's case, they're digging into some verticals like restaurant. And in PayPal's case, they acquired Swift, for example, to get into lending outside of their population. So you're definitely seeing the circles converge in small business lending.
So how do you compete in this new phase?
Well, from our perspective, it's all about customer experience. So we want to make sure that our customers can get access to the capital they need when they need it, and they don't have to worry about it. So we're really excited about our NPS, for example, which is in the mid-60s, which is on par with well-loved brands like Amazon and Apple. So it's really surprising that our customers are that excited about working with us, considering the fact that we charge them a fee for money. Nobody would expect that they would be that excited about that. So I think a lot of it is the experience. They can do it quickly. They don't have to worry about it, and they don't have to do a lot of stuff in order to make it happen. So 7 or 8 minutes, that's the whole time they invest. It's not like they're going out and getting financial statements and going to their accountant and uploading documents. There's no other time they have to spend, and time is the most valuable asset from their perspective.
Yes, yes. It's interesting you brought up NPS and your score there, because it seemed like one of the industry's biggest problems is a customer satisfaction rate that is lower than some of the incumbent competition. Community banks in particular, and credit unions, I guess, have the highest score in terms of the user satisfaction. What makes it special? Is it the time? And how does the industry as a whole overcome that hurdle?
Well, I mean, part of it, if you think about it, if you're comparing us to, say, a traditional bank, like, any of the top banks you might imagine, I think it's a little bit different because those banks, A, they're not using technology, they're not necessarily making life easier, they're not going to the customer, they're making the customer come to them on the bank's terms. And I think that's really important. The customer wants you to go to them. And that's a hard thing for a big, old business to do. Plus, they are so hamstrung by so many regulations that make it hard for them to move quickly and make changes and adapt to user needs.
Regulation is a topic that comes up a lot and has come up a lot today, will today and yesterday. It's headed your way. It can't be any other way. It's a financial institution. Are you growing into one anyway? How do you see it? Where will it affect your business? What do you see happening, and how are you trying to manage the regulatory risk?
It's interesting, a few years ago, none of the regulators had even heard of any of us. And then the Treasury had a roundtable event, and we participated in that, in a couple of them. And that's where everybody sort of began to get anxious about the space. Like, what is this thing? What is this FinTech? What is, at the time it was all about P2P, and then it was about marketplace lending, and now everything's just FinTech. But I think there's a lot of education that's happened in the intervening years. So I've spent a ton of time in DC and at the various state authorities, talking to them about our business and really generally providing education. And I have to tell you, they are so happy to talk to companies who aren't in trouble. And they say that all the time. They're just like, thank you so much for coming, because nobody wants to go to them, because you're always afraid, like, oh, if I just put my head in the sand, then maybe you're not going to know that I'm here. And we've taken a different approach, and I think it's really been good for us, because we've enjoyed our conversations. It's been a little bit weird. This current administration isn't as interested in what we're up to, so we were all prepared for a totally different environment than what has happened. And I think what I wasn't expecting, probably smart people who know this space would have expected it, but when there's a void at the federal level, the states step up. So we're seeing a lot more state activity, and that's frankly harder to manage. We were really excited about the idea of a federal charter for FinTechs, and we remain excited about that, but it's not really going anywhere right now.
And the states are difficult because they all have different rules, and that's 50 visits you have to make as opposed
That's
to one.
exactly right.
What do the regulators care about most?
Transparency, without a doubt. That is what we heard about the most when we first started engaging in DC. And that's one of the reasons that we decided that we wanted to do something like the ILPA, because we wanted to get ahead of that. The number one thing they want is to make sure that customers understand exactly what they're paying for money that they're borrowing. And we couldn't agree with them more.
Good. You have recently acquired Orchard, which is a lending technology company. What does Orchard add to the capabilities you already have, and is this the beginning of an expansion trend at Kabbage?
Well, we were already working with Orchard, and so we were really excited about the tools that they had developed from our perspective, from an asset management perspective. And so, number one, there was a lot of alignment there. The second thing is really the people. We were able to bring on board now over 20 people with the strong focus on data engineering and software engineering, and those are skills that we need and that are important to us. So a lot of it was about the people, and a lot of it was about the technology, but they really understand how to work with large quantities of data, which is something that we do every day.
Some of the companies in the field that have gone public, Bondec, Lending Club, have disappointed from their IPOs. Maybe it's a matter of unreasonable expectations at the beginning. Maybe it's a matter of weaknesses in the industry that were exposed. With the lesson that they have uncovered in the market, what's your outlook for the industry as a whole?
I would say, they were definitely the canaries in the coal mine, and I think part of the challenge was a misalignment of expectations, and different analysts were covering that space. They were tech analysts, not financial analysts, and so I think that probably drove some of the difference. I think what they didn't see was the flywheel effect that one would have expected technology might have brought to that type of business, and I think all those businesses are working really hard to be able to demonstrate that, but I think it's been a hard slog. You have seen some great things happening. Green Sky, and another Atlanta-based company, went public, and they're doing really, really well. So I think that the future is bright for sure. Again, it's just a matter of aligning expectations.
Okay, all right, good. Let's look ahead to the future. After all, that's the theme of our event. Over the next 5 years, what do you see in the industry that is going to surprise people in the audience?
Well, I think we're already seeing it a little bit with respect to companies like Amazon getting into lending or getting into healthcare, or sort of the bleeding that's occurring between companies where you might not have expected them to get into particular industries. I think you're going to see a lot more of that. I don't know if it's necessarily surprising. I think what is going to surprise people is the impact of younger people, the millennials. I really hate using that term, but that population moving more into the workforce and more into the customer population, because they have different needs and demands, and I don't think we fully understand exactly what that impact is going to be to us. For example, there are only 5 millennials in Congress right now. There should be, based on the population, there should be 25 or 30 of them. And so as that shift happens, I think we're all going to wake up and say, wow, it's a totally different world out there. And how are we going to manage expectations as a big company and change rapidly to adapt to their needs?
That's interesting. That generation also is very entrepreneurial, which fits right into your customer set. Do you see the movement of big companies into your field as a kind of obstacle to continued innovation, or will the deep pockets actually accelerate it?
I think Some of them have I think some of them will have the ability to move into that space and to do really well, and I'll use Amazon as an example because I think they do a great job. And I actually love, it's funny you brought up customer satisfaction earlier. Jeff Bezos has a statement about customers, and I'm going to misquote it, so whatever the right one is, forgive me, that they're delightfully unsatisfied along those lines. Like no matter what service you're providing to your customers, you can give them the same service tomorrow, and they're not going to like it as much, even though they loved it the day before. So I think companies that are going to be able to manage that expectation are going to do really well. So companies that focus on the user, focus on that experience, and less on just delivering them the product that they want to give them.
All right. Last question is for this audience, what's the one piece of advice you would say about how to succeed in the industry in the next 5 years?
I would say you have to be open-minded. You know, for Kabbage, we just keep drawing these circles around the business. People always say, oh, well, you had a pivot. We still do the same thing we did at the very beginning. We just do more things, and we circle around that. And if you're not open to the opportunity, and you don't try new things, and even if some of them don't work, we had a brief foray into consumer lending, and we don't do that now. So it's important to try things and, you know, to see what works, but to be open to the opportunities.
Terrific. Thank you. Kathryn, Petralia, thanks very much.
Thanks.